Okay, well, welcome everybody who was waiting there for me to get online. Hopefully everybody can hear me. Got my chat set up correctly. Where am I at here? Okay, so yeah, as always, just make sure you let me know in the chat if you can actually hear me. Most important, hopefully my sound is turned on correctly. I'm not actually seeing any comments show up, so don't know what the deal there is. Close that down. There's the chat. Yes. Thanks, John. Apparently, yes. Okay, I didn't have my chat turned on. Rookie mistake, of course. I'm very new to this, so apologies to everybody. We have some technical difficulties every time I do this, so today will probably be quite similar to that. Just going to wait for a few more people to roll in. I tweeted it out. I sent it out on LinkedIn, so hopefully we get a few more people. There was a few more from the second one to the first one, so yeah, it wasn't a total miss. Oh, I got my screen on wrong already. Where's the starting in clock? There we go. Counting it down. One interesting thing, too, I noticed that people can comment before I even went live. I saw another worldly device. I saw the comment before I actually hit the live button, so thanks for that test there. Sounds good, sounds good. All right, great. Thanks, Tom, for showing up. Wayne, thanks for the support. Greg Martin, I see you all there. I see Vanessa there in the chat. She's always #1 fan. Nice background. Greg, yes, this is Vancouver. So I was going to say this in a few minutes, but one of the issues I have with my comment section is I really do need a second monitor. But right now I'm currently in Vancouver, so this is Cole Harbour behind me, and I'm basically packing up and getting ready to leave Canada soon. So I didn't want to buy any new equipment. I'm going to go ahead with this stream and just see if I can manage the comments with just my laptop. So, but yes, this is Vancouver. As soon as I decide where I'm going to go next and set everything up, I will go ahead and get a second monitor and actually be able to be a little bit more technically savvy with this stuff. Right now, my style has always just been single laptop. That's all I've ever needed for my trading. So you see on Twitter, you see these people with a bunch of screens in front of them. They show their setup, and it looks like the Matrix. That's never been my style. I'm always single laptop. That's it. Oren, yes, leaving Canada soon. Yes, I do move around quite a lot. I'm not, I don't live anywhere permanently. I do move around quite a bit. And I've been in Canada for 4 months now. It's not that it's stale. I love it here, but time for a new adventure. So I'll let everybody know where I'm off to next. Could be Taiwan, could be Panama. I've got a few other ideas depending on the whole COVID situation, the bug. So we'll see. But yes, my time in Vancouver is probably about done for now. I'll be back later in the year. I love it here, and I am Canadian, so of course, I always come back every year. Once you go to a second monitor, you won't go back. I hope not, because I do like to make sure that my entire setup can travel with me. I am a minimalist. I can fit every possession I have in this world can fit in 3 suitcases. So hopefully I don't turn into a person that needs to have a home base, because that's not my style. All right, so we got a few people rolling in here. So I'm going to just try a little bit of an intro video here on you. I don't know if it's going to be visible or playable, but I'm going to go ahead and start the show, and hopefully you can see this video. It's sort of a test and a little intro video, so we'll see what this looks like. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. All right. Little bit of housekeeping there. Sorry about that. Let me know in the comments if you actually saw that video or were you just staring at me the whole time at a blank space. I can't tell what it looks live. On the back end, everything seemed fine, but just let me know if everybody actually saw that. Plain and working. Thank you, Zachary. So let's go ahead and get started. And as I've mentioned before, since I'm really new to these live streams, I don't even know if this experiment is going to last very long. I really don't know. It's going to be contingent on how well I can communicate a message live versus doing something that's prepared and edited and my usual style of videos. So if I happen to get a little bit better at this and I can have a topic and go start to finish and it's reasonably well presented and I didn't forget too many things, then I think I will go on this live stream. I think people enjoy it more. I can see the comments, definitely more interactive. But if I do find that I'm just forgetting too many things and maybe not as good of a presenter as if I did an edited scripted video like I usually do, then these will just be probably Q&A sessions. But we're going to go ahead with last time, the format where I chose a subject, talked about it for a little while, and then open it up to questions. So the subject I wanted to talk about today is, I labeled this one Volatility ETP Termination. And I just want to make clear that while I am going to be talking about what causes the termination of these volatility products, what has happened in the past, how likely it is to happen in the future, I do want to make sure that everybody understands that I'm not just talking about whether you buy the ETPs or not. This applies to options trading just as much, if not more, than the actual ETPs. Because options, especially if you're doing shorter dated contracts, they can move even faster than the underlying ETPs. So just because that's the backdrop and that's the subject, don't think that you're safe just because you trade options. So in fact, like I said, it might even apply more if you're an options trader. So the first thing is, whenever we think of termination, of course, we think of the XIV. All right, people probably remember that old XIV. It was a one-times inverse product of the SPVIX STR index. And it terminated on the Volpocalypse event, as we call it. Volmageddon, insert your natural disaster, add vol in front of it. You've probably heard it referred to like that. So, Volnado, I don't know, hurricane, Volmacane, whatever it is. People often use natural disaster with vol, but I like Volpocalypse. So February 5th, 2018, we actually lost the XIV. And when it happened, of course, it was shocking. People didn't realize that that could even happen. And when it did, even those of us who knew that it could and probably would at some point, even I knew it was going to happen, but I was still surprised when it did. So I put out a little warning, well, not a little, several warnings. I wrote several articles and did several videos talking about how these products would eventually cause some issues for people who don't understand them. So I just wanted to play that old video, just a little segment of it. Again, kind of a test, but also there's a little bit of a lesson in there. So I'm going to play this. Apologies for the sound quality. It's my actual file for the video is on a hard drive that I have back in Taiwan. So I just had to record it straight from the computer. But let's play this little 1-minute clip. However, the XIV has one potential downside that needs to be addressed. In the prospectus for the product, there's what's called an acceleration clause, and essentially what it says is, if there's a market event that drops the price of XIV over 80% in a single trading day, the product can be terminated. Now the question becomes, how much of a concern is this really? Is it possible for these products to lose 80 to 100% in a single day? The short answer is yes. Now in a practical sense, the odds are pretty low, but it does need to be said that this is technically a possibility. And if you view it through the lens of quantum mechanics and Murphy's Law, one might be inclined to say that on a long enough time horizon, it's not only possible but likely. The Black Monday crash of 1987 would easily have done it. So whether an event like that can happen again in the future is up for debate. But the way I look at it is, acknowledging that volatility products can go to zero in a single day is valuable. It makes the trader put risk management at the forefront of their strategy building. It means that no matter how badly we want to get aggressive and shoot for huge profits, as responsible traders, we just can't. Nobody knows if and when this type of event will occur. So really the only line of defense is making sure that we're only allocated to trades during the most ideal times and making sure we're in cash for all of the rest. All right, so again, hopefully you heard that video. Kind of learning my software here, how to include little clips here and there. But that video from 2017, early on in 2017, from that guy who, used to still put on a shirt and tie for these types of things, he's absolutely right. No one knows when and if these events will occur. So obviously we want to be fully prepared for when they happen. And later on, after I go through a little bit of the statistics surrounding that Volpocalypse, I'm going to give a little quick breakdown of some things that you can look out for that will definitely make your trading safer, that might be able to get you on the sidelines or perhaps not as allocated when one of those terrible events happens. Because honestly, it's probably going to happen again. I mean, I think it's always a good idea for people to just assume the worst and not at some distant point in the future. Look at your portfolio right now today and assume that there's going to be a flash crash tomorrow. How prepared are you for that event? If there was a flash crash tomorrow, what would your portfolio look like? That's the mindset that you want to go into these things, because volatility trading, I don't care how good you are at it, how well you manage risk, how much you think you know about the market, it does have a way of surprising even our worst expectations. It is riskier than regular investing. So I'll get into a checklist later on. But the first thing that I wanted to show you, of course, after I gave that warning, within a year of giving those warnings, we know here's what happened. So I'll make sure I do screen share. I had that malfunction last time. This is what happened to the XIV on Volpocalypse, right? This right here, this disastrous collapse. So this is showing the XIV from simulated prices going back to March 26, 2004. And you can see it started out at $1.28 and it made its way all the way up to $108. Now, these are large crashes as well. This is a 75% crash. There's been many 75%, several 75 or 60% crashes along the way. So it's not like it was totally safe, and there were red flags all along. But this last one, this last kill shot, from $108 to $4 in a single day, right? Down 96% of its value. So obviously that's pretty diabolical results. Now, what we need to know is that's not, let me pull up that again. This crash is not because of supply and demand. It's not because, actually I should be going on full screen. Sorry, bouncing around. It's really important to understand that that's not because a whole bunch of people got scared and started selling the XIV, and that selling caused the XIV to go down. Remember, supply and demand is not the operative thing here. These ETPs function entirely on a methodology of tracking what they have, a 30-day constant rolling contract. Now, if you want to know more about that, I have a video on my YouTube channel very recently. I think it was called something like Don't Buy VXX. The roll yield crushes it, something like that. That'll explain that whole thing. But essentially what I'm talking about is this index right here. This is the SP-VIX STR index. And this is essentially identical to the 1 times long VXX product. And that XIV that crashed that day, the XIV that crashed 96% in a single day, is based on this index. So if we just go to 3 years, and we can include that Volapocalypse spike, you can see over here, on February 2nd, it was at 56.28. And on February 5th, it was at 110.37. So if we just do a quick calculation here, 110.37 minus 56.28, and then going from a starting point of 56.28, we've got a one-day spike on the SPVIX STR index of 96.1%. So that's why, when we look at the actual XIV, that's why we see it down 96.1%. On that day, it is an inverse on a one-day basis of the SPVIX STR index. So that's really important to understand that this had nothing to do with supply and demand and a bunch of people getting scared and selling the XIV. That's not why it crashed. SVXY, the same thing. It's basically a mirror product. It uses the exact same methodology. It also crashed 96% that day. But again, it's based on this underlying index. Okay, so that's obviously a very important fundamental thing to understand about volatility products, is that it is always based on this index. So UVXY is 1.5 times this index. The old TVIX that was delisted, 2 times this. The new SVXY at its deleveraged level of 0.5 times. It is a 0.5 times leverage inverse one day of this index. Everything is based on this. Okay? So that's why the XIV crashed 96%, because the underlying index and its methodology did as well. So, when we talk about the largest spikes in the past, October 1987 has to come to mind, right? So what we're going to look at here, this is a chart comparing what's called the VXO to the VIX index. Now, hopefully most people in the comments, you know what the VIX is. It's a calculation of S&P 500 options, right? It's measuring forward implied volatility. The VXO is essentially the old VIX. It was using the S&P 100, not the S&P 500. And the VIX index can be calculated back to 1990, but the VXO can actually be calculated a little further back. So while we can't see exactly what the actual current VIX was doing in 1987, we can see what the VXO was doing in 1987. So this here is the old VXO measuring based off of the S&P 100. This is essentially the old VIX through 1987, start to finish. So you can see that it was slightly higher volatility during that time period. Sorry, I've made this mistake before, just checking if it's screen share. All right, looks good. So you can see that the VXO was a little bit elevated throughout the year, right? It looked like bouncing around between about 18 and maybe 30. And right before, on October 16th, it closed at 36. And then on Black Monday, right, the following Monday, October 19th, that infamous day, it closed at 150.19. So that's a one-day VXO spike, essentially a VIX spike. The VXO tends to under-capture a little bit, but it's very, very close to the current VIX. So it could have spiked as much as 312%. And on an intraday basis, you can see 172.79. So the VIX intraday may have spiked 375%. Now, obviously, that's going to cause major problems to the market, not only for people who are buying stocks, but if volatility products existed back then, obviously that would have been a major problem for anybody who was holding volatility ETPs. As we can see in this chart, nothing even close to that has happened since then. The largest the largest VIX spike being 115% in a single day. That was on Volapocalypse that day. And this sort of moderate volatility spike compared to the old VXO in October 87, this actually terminated the XIV. So it's just good to know that historically speaking, when you're talking about the VIX index, when we're talking about volatility data, VIX futures launching in 2004, we don't actually have a lot of data going backwards, right? It might sound like a lot. You know, we've got 15 to 20 years of VIX futures data, since 2004. We can recreate the VIX going to 1990, but that's not actually that much data. So it is important to get a general context of what could happen and what has happened, not just what could, but what has happened already and most certainly could happen again. We had the flash crash in 2010. It was bad, but I could certainly imagine a flash crash happening maybe tomorrow. Not to get too alarmist, but remember, always plan for the worst. Look at your portfolio, and if it happens tomorrow, then make sure you're protected. But I could totally see a flash crash being even worse than the one on May 6, 2010. So, just keep those numbers in mind. Now, one thing that I wanted to talk about, let me just check my notes here. Apologies for that. This is what makes live streaming hard, is that I want to make sure I don't actually forget anything. Okay, there we go. I wanted to just explain really quickly. When people eyeball this chart and they think, wow, it spiked 115. Oh, that is a mistake. Screen share. Glad I caught that quickly this time. See, I can learn. When people look at this and they see that the VIX spiked 115.6%, they might be confused as to how that translates to an equivalent move in the XIV, right? The XIV only crashed 96%. And oftentimes people confuse the VIX and the volatility ETPs and the VX30 rolling contract. It's all very confusing. So what I wanted to just demonstrate is how much that SPVIX STR index actually moves compared to the VIX index. So this is on average. We call this beta factor. And what beta is a measure of how much one thing moves in relation to something else. So here we've got the SPVIX STR, that is that index, the underlying index for all of these volatility ETPs. How much does this move in relation to a spike on the VIX? Okay, so this is the beta factor. If we go to the long-term chart, we can see that it's about 0.49. So just for simplicity, we will say that the SPVIX STR index, on average, moves about half as fast as the VIX index. So if the VIX spikes 20%, we can expect the underlying SPVIX STR to spike roughly 10%. Now, this is just a long-term average with quite a bit of variation in between. It can significantly underperform. It can significantly outperform. That's just a long-term average, but it moves about 50%. So when we say that the XIV crashed 96% on this day, one thing I want to mention to people is that that didn't happen throughout the actual trading day, right? Throughout the trading day, I don't know if you were around and watching it happen live, but when the XIV was doing its thing that day, it actually behaved fairly well in regular market hours. It was actually only down about 35% in regular market hours. And if the SPVIX STR index was up 96% and the VIX index was up 115, one could make a case that the XIV should have probably been down about 55% in regular trading hours. That is according to the long-term beta factor. But remember, there's a lot of variation. So the XIV actually performed reasonably well that day during market hours on February 5th. But what ended up happening was in the aftermarket rebalancing, there's a 15-minute period from 4 o'clock to 4:15 where all of those volatility ETPs have to start doing their daily rebalance. And that's when things got really crazy. So XIV did reasonably well. I mean, it wouldn't have been a fun day for anybody holding it. Side note, I wasn't. I was in cash well ahead of time. But if you were holding it, it wasn't that disastrous up until 4 o'clock, down 35% or something. And then because of the liquidity, because of all these volatility ETPs, at the time about 5 billion notional value of volatility ETPs out there, all of them doing their daily rebalance at the end of the day, all of them buying VIX futures, it caused those VIX futures to spike up to insane levels. It's essentially a liquidity crunch, and that's what caused all of these problems in the 15-minute aftermarket, where it went from 35% down, not so bad, down 96%, wake up the next day, and we realize that they're just going to terminate the product. So again, it's very important to understand the beta factors of how these things interact with each other. So if the VIX spikes a certain amount, how much would we expect the VXX to move? How much would we expect the underlying index to move? What does that mean for VXY? These are all things that you can calculate, right? Of course, for me, I keep very detailed spreadsheets. I've got, these spreadsheets that crash my computer, so I have to divide them up. Like this is VIX source 1, I've got VIX source 2, 3, 4. I've got many spreadsheets, but all of the data, these things can be calculated. And it is very important to understand the relationships between these things, between this index and how the other things actually work. So let me check my notes again really quickly here. Sorry, I'm misfiring a lot here. There's my notes. Yeah, so talking about going back to the October 1987, I always find it fun to look at it. I don't know if you guys do, but just trying to imagine what would have happened this day. So obviously a spike of 312%, right? Close to close. This would certainly have crushed every inverse volatility ETP out there. So XIV, SVXY, even the ZIV might have had major problems. There's a different index for the midterm futures, but yeah, it could have been a problem across the board. But the one thing that people don't understand, again, very important to understand the products that you're trading, is that long volatility ETPs can also terminate. This is something that you very rarely hear people say, but it's not just the inverse products that can terminate. TVIX can terminate as well. UVXY at its current leverage factor could potentially terminate. And now that you know what these are based on, remember it is based on an underlying index, what would a termination of a long volatility ETP mean? That would mean that the vol crush on the other side of the spike was also significant enough to crush the long volatility ETP. So you can see here, this is going back to Volpocalypse. It went from 56 to 110. If on the next day or the next couple of days, you get a one-day change that goes from a very high level to a much lower number, and it's significant enough, it could start terminating the long volatility ETPs. So you can see it goes from 110 to something in the 70s. Now that's a big move, but that's not quite big enough to crash it. So the official closing value the next day closed, I believe, at around, if memory serves, 81.66. That's a number that seems to ring a bell, something like that, 81.86. And if it would have gone down to something in the mid-60s, then the TVIX would have crashed. So we could have, during that Volpocalypse situation, we could have had a situation where XIV terminates on the 5th because, of course, the SPVIX STR index spiked up. And then if the next day some type of news comes out, people digest the information, and they realize that it wasn't quite as bad as we thought it was, and you get a major vol crush the next day, that can terminate the long volatility products. And TVIX is 2 times leverage factor of that underlying index. So it only has to go down 50% the next day in order to crash. And I think I have the data on the October 1987 spike. So when it went all the way up there, the very next day in October 20th, it was kind of stable, right? So it went up to 152, and then it was fairly stable. It went to 140. But the day after it went to 140, it actually dropped down to, I don't have that number. Sorry, I'm going to have to go on memory here, so don't fact check me in the next live stream. 71 something. Intraday, something like 71. So about a 50% decline. And remember, at 80%, that acceleration clause can start kicking in. So it doesn't even have to go down 50%. It can go down 40%, and then the issuing bank can start considering that acceleration clause. Of course, they can do that anyway. They can close anything they want. But as far as the prospectus goes, it would have had to do that. And in 1987, that surely would have happened. So not only in 87 would we have lost every single inverse product, but we would have lost TVIX almost for sure. We would have maybe lost UVXY at a 1.5 times leverage factor, because although the close-to-close value wouldn't have done it, the intraday value probably would have. So we may even have lost that. The only product that would definitely have survived that October 87 crash is the VXX, the 1 times underlying. This SPVIX STR index, why do I keep forgetting to do that? The SPVIX STR index would not have done enough to terminate the VXX. And it wouldn't have been enough to terminate any of the midterm products on the long side either, the VXZ, stuff like that. But probably good information to know, right? Because I always operate on the assumption that anything that has happened in the past could definitely happen again. And if you operate based on that assumption, that means that we are all, as volatility traders, we are all operating in a market that could see another volpocalypse. That could happen. And again, just because you don't trade vol ETPs doesn't mean your option trading is any safer. It applies to all of us. We have to know that these risks are out there. And this has happened before. It's probably a good idea if you're a trader to always assume that what has happened before not only can happen again, but will happen again. So you just want to make sure that your risk management techniques are adequate to protect yourself. So that's the last thing that I want to talk about here, is just a few steps of risk management that are probably just best practices for anybody out there who's trading volatility ETPs. And then after that, I will open it up to questions, and I'll try to catch up on this chat. I can see it going. I can see some questions. But let me just finish off this really quickly. Let's go to the screen share here. Here's some things that I think people should probably keep in mind. So the first one, reduce risk on the underlying you trade. No leverage, no undefined options. So I think this one is obvious. If you are trading volatility ETPs, it's probably a good idea to not trade the leveraged ones. And trust me, you don't need the leveraged ones to make a bunch of money. You can be plenty profitable using VXX and the new 0.5 times SVXY. You can be plenty profitable trading those things. You don't need to go into the UVXY. And certainly if they relaunch a TVIX at some point, you definitely don't need 2 times leverage factor. And then this applies to the options world as well. You really don't need to be trading undefined risk options to make money. You can make just as much of a profit trading defined risk spreads, trading things that are more protected against a spike. You really don't have to take on that risk. I know sometimes it sounds like that's a good idea. Let me go full screen here. But the thing about this is what a lot of people are misunderstanding about the options world is, let's say you're trading a short, a naked call option on the UVXY, right? This is a trade that people ask me about all the time. Is it safe enough? If you go look at the premiums of a naked call on the UVXY, it seems high, right? You're going to be looking at a number that seems like there's some really juicy premium there to sell. And then if you go on the other side and you sell a naked put, for example, the premiums don't seem nearly as attractive. And you look at those two trades and you think, well, clearly I want to be selling the call. I can get 4 times as much premium into my account, right? What you're not factoring in, and this is what a lot of people forget, is the risk. When you sell a naked call on the UVXY, you have to take your position sizing down so far to a point where it's actually safe enough to do that. And that costs you money. And then you have to hedge the position, and that costs you money. And then you have to do other layers of risk management along the way to make sure that that position is safe enough, and that costs money. So the point of volatility trading, in my opinion, the best way to make a profit is to get the most amount of capital allocated in the least amount of risk possible. And that doesn't include undefined risk spreads. It just doesn't. Selling naked straddles on UVXY does not allow you to maximize the amount of money you're putting into the market and minimizing the risk while doing it. Vertical spreads do that, defined risk trades. Selling short puts can do that. Buying long put options in the VXX using the stock replacement method, it can do that. You can allocate very large amounts of capital, and the risk management is largely built into the trade. So it's not a fair comparison to just look in your software and say, well, that premium's really juicy on the naked calls. I'm going to go ahead and do that. You're not factoring in all the layers that you have to drop that down, and it's going to cost you money at every step of the way, and eventually you're going to wind up with a trade that, while it seems like there's a lot of premium there, you're actually going to make less money than if you would have just allocated large amounts of capital into safer strategies. You're going to make more money doing it that way. So a little bit of a side rant there. A lot of people don't understand that it's not about the upfront premium. It's about the long term. And undefined options, again, just make it a hard rule. No undefined options on volatility ETPs, full stop. What if there's a flash crash tomorrow? What if there's another October 1987 next year? If you're just getting in the habit of cycling through these seemingly easy trades, you're just picking up pennies in front of the steamroller, and eventually you're going to pay it all back and then some. So just make some hard rules, no leveraged products, no undefined options. Trust me, you can find plenty of ways to make all the profit you need using much safer strategies. So the second one here in orange, reduce your portfolio allocation to a manageable level. I think this goes without saying. If you had a $100,000 portfolio, for example, you don't want to dedicate all $100,000 to volatility trading. For me personally, my tactical vol strategy, it's only a 20% allocation in that portfolio. The aggressive vol, same thing, only a 20% allocation. If you're extremely safe and you have several layers of risk management on, then perhaps you could open that up a little bit wider of a net. But for most people, obviously I can't give out any personalized investment advice, but for most people that, 10 to 30% range is about where you want to be. Don't go more than that. Always keep your allocation small to volatility trading because it is inherently risky. Anybody who says otherwise, maybe they say they're great at managing risk, they're great at exiting trades before bad things happen. Doesn't matter. It's still inherently risky. Those products move very quickly, and so do options. There is no way to 100% be safe when you're trading them. So number 3, in yellow there, only allocate to the highest quality trades. And of course, cash is your friend. There's absolutely nothing wrong with just sitting on the sidelines. If you have signals or if you have a strategy that's just currently not conducive to the market environment that we're in, there's absolutely nothing wrong with moving to cash, taking some time off. Sometimes the hardest thing to do is to just sit on your hands and do nothing. But quite often that might be the best thing to do, especially with volatility trading. So for me personally, again, don't mean to keep referring to my own strategies, but for the tactical volatility, we are only allocated about 42% of the time, somewhere in there, depending on the market. And the rest of the time, we're just in cash. The aggressive vol is much higher. It's about 68, but same thing. We've got plenty of cash positions. I'm not just trading for trading's sake. If it's not the right environment for that strategy, go ahead and sit in cash. Absolutely nothing wrong with that. And the last one here, have the ability to move to safety quickly. Now for that one, this will of course depend on your situation. But what I mean by that last one is you don't want to put yourself in a situation where you're getting into trades that can move quite quickly, right? Volatility ETPs or option trading, and have your personal situation be that you can't exit those trades quickly. Maybe it's for tax reasons. Maybe it's the structure of your account. Maybe the broker you trade at doesn't allow you to cycle through trades that quickly. Maybe you partially have a position in the financial industry and you're regulated against cycling through trades, or whatever the case may be. If you're in a position where you can't exit your risky positions almost immediately, then don't put them on. Or at least make sure they're extremely hedged ahead of time. Because the last thing you want to do is wake up one day, get hit by a vol-apocalypse event, and then have your account structure or the way that you've set up your portfolio that you can't exit. You just have to sit there and watch it happen. So that's that last little bit. For me personally, I can cycle out of every position I have on a one-day notice. So it does allow for a little bit more nimbleness there when we're facing extreme events like that. So keep those 4 things in mind. If you do stick with these, I think you're probably going to be okay. As long as you trade the right products, you're not using undefined options, you're only trading a smaller portion of your portfolio, you're only allocating capital when you really do see those good opportunities where your strategy can take advantage of, and if necessary, you can cycle out very quickly. If you're sticking to this, I think you're probably going to be okay. Obviously, I've been trading volatility for 15 years. I'm not here to dissuade anybody and to say that it's too risky, don't even bother. I do it. I've been doing it heavily, and it's a major portion of my portfolio. But that doesn't mean that we don't always have to be mindful of the risk factor here. And there is risk. There is unknown risk. I'm very good at getting out of positions before they get out of control, and I've never suffered a drawdown. But I'm allocated to a position right now short volatility? What happens if I wake up tomorrow and, God forbid, there was a terrorist attack? I don't know what's going to happen tomorrow, so I have to make sure that the position size is small, that, I'm going to take a big hit tomorrow, but I can get out of that position on the very next day, things like that. We have to have layers of protection because none of us can fully guarantee that we can navigate this volatility space safely. And another thing that I would say is oftentimes on Twitter, I see people talking about how they can just exit their positions if things start to go badly. They can manage their trades or they can defend the position if they have to. Anybody who's saying that probably doesn't have any experience with a fast-moving market. And if you're even the slightest bit superstitious, trust me, the market gods that are watching over all of us, they've prepared lightning bolts to throw at anybody who says that you can manage your risk during the crisis. Doesn't work that way. Risk comes quick, especially in this volatility space, and there's no way that you can defend the position while it's happening. Once it starts, you better just hope that you had that list of things in place beforehand, because very little you can do in the moment. So that's pretty much my presentation there on October 1987. Some interesting stats there. I don't know if people realized just how bad that event was. Did you know that it spiked 312% and intraday 375%? It's a pretty big VIX spike. And very conveniently, if you were the type of person that says, I have the VIX data in my spreadsheet, an event like X has never happened. Well, that's because the VIX only goes back to 1990. Go ahead and drag that back test back 3 years, and now all of a sudden it spiked 375% in a single day. So don't let the limiting factor of the data set get you into trades that you didn't realize could happen like that. So let me just look at these chat. I know I missed a whole bunch of these, but I wanted to try this format where I present something for a few minutes, and then, of course, I'll open it up to questions. I think a lot of people do like the questions and just firing off stuff. So let me see what everybody's been saying. Yes, the best defense. I learned a little trick here. Let me see if it works. Can you guys see that? You guys see this comment? I think that's pretty cool. Because what I was doing before is I'm just reading out the question, but I didn't know you could actually click on the little avatar and it can go. Russell Rhodes, thank you very much for checking out another stream. I know you watched painfully through the last one where I didn't have my screen share on. So thanks for your kind comments on Twitter afterwards. Even a veteran like Russell Rhodes can make mistakes like that. But what he says is, it is good to know that the VIX can go above 80s. That's a very good point. I've seen people on Twitter talk about this a lot too, that all you really have to do is wait till it gets to 80 and then just feel free to sell any premium you want. Just go ahead and sell any unlimited, because it's never been higher than 80, right? Well, sure. But again, the limited data set means that we only have, 30 years of data? There's been a lot of terrible events that have happened in the past. And look, with these markets, with high frequency trading being 75% of activity these days, and I hate to talk about negative things, but cyber warfare and things like that, you have to assume that these events can happen. So like Russell says, a VIX of 100 is certainly breachable. I mean, if you think that just because the VIX at 80, it feels high, it can go to 170. It's not, there's no ceiling there. 100 means nothing on the VIX. The VIX is calculated based on S&P 500 options activity. There is no floor, well, the floor is 0, but there is no ceiling there. It doesn't stop at 100. It's not a scale that ends at 100. There's no scale. It can go to 172. Will it again? I don't know. That seems like an awfully high number, but very good point. Make sure that you know that it can go well above the all-time high. Okay. Maggie, that begs the question, what drives SVXSRT VIX futures? For more detailed answers like this, I will always have to default to longer videos because in a live stream, I can't possibly get into the details. So again, essentially what's driving these underlying futures is just the methodology that they're trading. So the SP VIX STR index is tracking a constant rolling 30-day maturity VIX future. Now, to understand that and what I call the VX30 and the relationship between the VX30 and the VIX, go ahead and check out that article. Let me try to pull it up here just to make sure that I know exactly which one it is. I think it was called Don't Buy VXX. Roll Yield Crushes It, something like that. It's called Don't Buy VXX. Let me show you the picture of the screenshot so you can find it really quickly. So this is the YouTube channel. It's this one right here. It's Don't Buy VXX, Roll Yield Crushes It Lower. And then if you want, you can also go into this little search button over here. You can go on Roll Yield, and there's another pretty decent video here called Why VIX Futures Roll Yield is So Important. You probably want to check out those two videos to understand what's actually happening in that underlying index. Now remember, VIX futures are a freely traded market, so what's driving them is just traders trading. But the actual methodology and the underlying VIX of the constant 30-day rolling maturity future, that's all explained in those videos, so I definitely check that out. Yeah, Hans, I want to know this as well. What would have happened in events like that? Because as we know, the stock market was down 86% in the Great Depression, right? And it actually took, again, don't fact check me here. A lot of these numbers I'm just going off memory, but I think it took 26 years for it to reach the all-time high again. So it certainly inflation adjusted, it took that long. But yeah, I would love to see what would happen there. I would love to see what would have happened in different periods too, like the mid-60s when volatility would have been extremely low. I'd like to see what the VIX could have gone down to then. Of course, we know in the early 90s it went pretty low, but I'd love to pick some of these historical periods and actually see what would have happened, especially to volatility ETPs. That would be very interesting. Unfortunately, we can't because we've got limited data set, and you can't simulate things on these products because they are based on VIX futures, which did launch on March 26, 2004. So we have a very short data set to go by. You know what? I should go back before I start reading all the new ones. Give me just 1 second to scroll through the older ones because I was talking there for, again, I can ramble on. Apologies, everyone, but that was about 40 minutes. So I didn't plan on doing it that long. I'm really trying to get 30 minutes of a presentation for you guys. Just pick an interesting vol topic, fire up some charts, and then get into the Q&A because I think this is what people want more anyway. So again, one from Hans earlier on, XIV crash because of how new vol products rebalanced. Yeah, it was essentially a liquidity crunch in the aftermarket where, you know, they have to do their rebalancing and they all end up having to buy the same futures, right? So the inverse products have to buy futures to cover what's going on, and the long products have to buy futures to rebalance their long exposure and make sure that they're exposed correctly the next day. So they're essentially just piling into all these futures. And from 4 to 415, essentially the market broke. There was just the VIX futures market, while it may sound big, it's not actually that large a market, but the vol ETPs became so large that that rebalance just overwhelmed the market. I have a metric that I track myself. I call it the Volpocalypse threshold. And essentially what I'm doing is I'm tracking the size of the volatility ETP space, the total notional value of the vol space, comparing that to the total notional value of the VIX future space, just to kind of get an idea of how much risk there could potentially be for a volatility event. Now, just a little side tangent here as well. There's a new product. I've mentioned it before. I think the ticker symbol will be SVIX if it ever gets launched. It's been a year now. But there's a new filing for an inverse product. And what makes it interesting, and I did a full video on it, did a full 10-minute video explaining it, but what makes it interesting is they were probably going to be addressing the 4 to 415 rebalance period to allow for some rebalancing to happen ahead of time. So it's probably going to relieve some of the stress on that aftermarket rebalancing. And if some of these new vol products, hopefully they can pass regulators, if they can also address the major issues that they face, not so much that they're risky during market hours. Like I said, XIV didn't terminate during market hours. It was only, well, not only, but it was down 35% or so, and then it got obliterated. So if some of these new issues can actually solve that problem, that would be very, very helpful. Okay, I got to that one. Thank you, everybody, for all the questions. A lot of smart questions here, too. A lot of questions that might give me ideas for future streams as well, because some of these I can't possibly answer in 5 minutes. But keep asking them, keep asking these questions, and after I watch the rebroadcast, I'll take notes. If somebody asks something that I thought, oh, there, I can do a 20-minute spiel on that one, that's probably how I will function on these streams going forward. So UVXY is one. Let me put it up on the screen. Adam, UVXY is 1.5 times leverage. If drawdown 50% would be down 75. Why terminate? If you're assuming that the drawdown was only 50%, then I guess it wouldn't need to terminate, would it? But A, these products can close anytime they want, right? We saw that with TVIX and ZIV and that whole list of products that Credit Suisse delisted. They can do that anytime they want. So if they happen to just want to get something off the books, they can go ahead and do that. But the other thing is that acceleration clause, that 80% level, they can do it or they can not do it. Like the SVXY didn't actually delist the next day. So apparently whoever's in charge of that ETF decided that maybe they're just going to give it another day. I don't know. I feel like that was quite a risky decision on their part. And again, I don't know what happened behind the scenes. I'm not an expert on the actual structuring of volatility ETPs. There's a lot of people out there who know far more than me about compliance things. Russell Rhodes in the comment section. I mean, follow him on Twitter. I don't know if he's available to answer questions like that, but people like that know far more about it than I do, about the actual structuring of the products. But just keep in mind that just because XIV has that acceleration clause doesn't mean that that governs everything that they do. There is a whole myriad of possibilities here when you start getting volatility crashing that badly. So I would just assume that once it starts to go, everything's on the table. You could have UVXY staying, not staying, waiting for 80, doing it at 72, waiting for 95. I wouldn't put too much faith in the actual underlying rules. Henrik, I'll put it up on the screen, but I can't make many comments about politics. Short vol ETPs perform better whenever there's a sane POTUS. Has there ever been one? I don't know. I'm one of those people. I'm an equal opportunity offender. I don't play favorites. I don't pick sides. I think they're all on the same team. That's just my personal opinion. I don't know. I don't talk about politics. I don't see a whole lot of difference between, as far as competency goes, between a Trump administration and a Biden administration. But that is just my personal opinion. I'm an equal opportunity offender. Again, another political one. We'll leave that aside. I get asked a lot, why don't I talk about politics? Somebody else asked that. Why don't I talk about politics? Well, I'll answer that really quickly. Go on a little side rant here. First reason is because it's never a good idea to alienate half of your, half the people that follow you, right? I mean, if I make negative I happen to equally dislike all politicians, so I'm kind of in the clear on that one. But let's say I did have a preference of one or the other. It's never a good idea to alienate half the people that are following you. But the other reason, I think, is just respect and just being a human being in this world. You have to understand that 74 million people voted for the other guy. So you can't possibly think that they're all idiots and you're the smart one. And then I think that, let's say I was a Biden supporter, which, I'm not a supporter of any of them, but what makes me think I'm right and those 74 million intelligent, hardworking people are all wrong? it always strikes me as disrespectful to do that. So that's why I don't talk about politics, because there's really nothing to gain, but it's also just disrespectful to all the other people who, trust me, they arrive at their belief system just as well-founded as you do, just as well-founded as I do. Everybody deserves to go through that process of building their belief structure and following and supporting whoever they want. It doesn't make them smarter or dumber or any of those things. It's just, let's be humans. Let's just, I don't care if you're a Trump supporter. We can still be friends. I don't care if you're a different religion or a different or no religion. We can still go golfing. We can still hang out. This is absurd. This whole, that's why I don't get into politics. And probably I don't know much about it. So I try to stay in my lane and might end up sounding kind of stupid. So here's a question from Chris. This will be specific. Do you track the performance for the individual segments of the volatility rotation in your strategies? Which positions do best? Could you give an example for one of your strategies? I do. Yeah, I absolutely do. I can't load up that spreadsheet because it takes about 3 minutes to cycle through. It's one of my longer ones. But if you go on the website, the best example would be that strategy called VB threshold. And what I do there is I essentially have designed my own volatility index that's much better than the VIX. So if anybody wants to follow my volatility index, it includes all of the metrics that I feel are important, and it's all combined into a single index. And then I divide that into different 20% sections. So yes, I can narrow it down and I can tell you how it does during different volatility ranges. And I've actually done some articles as well talking about dividing it in 5 sections or dividing it in deciles into 10 sections. And I can show you what sections are best for short vol, which ones are best for stocks, which ones are best for holding gold. These are all things that we can calculate and things that I do regularly calculate. That's occupies a good portion of my day, just going through these, just mining data and going through those numbers. So yes, I definitely do that. If you want to email me, I can give you more specific examples. I can prepare some charts for you. There are some articles on my website, and there's a search function as well, so you can maybe use that. But yeah, not only do I, but I would recommend everybody know that information. Again, it's all about understanding the products you're trading, and I understand very well what is in my portfolio, when it does well, when it doesn't, all the bands that I'm looking for, all the ones that are probably going to lead to more drawdowns. I know all of that information. And hopefully other people who are trading their own strategies, they know all that as well. Here's a question from Andrew. Future video blog idea. How VIX options are different from normal, well, I covered it with a little thing. How different than normal equity options. Yeah, I touched on that a little bit in my last stream. One of the major issues with VIX options, beyond the fact that a lot of people don't understand that it's the underlying for VIX options isn't the VIX, but one of the issues for VIX options is that you can't actually hold the VIX. You can't own shares of the VIX. It's an untradeable instrument. It is just a statistic measuring S&P 500 options activity. So a lot of kind of wacky things happen in the VIX options market when you can't actually have the counterparties and the market makers being able to hedge directly with the product. So you've got that coupled with the fact that it's a somewhat mean reverting index, or more specifically mode reverting, because someone's going to bite my head off in the comment section. It's not mean reverting, it's mode reverting. It's both, but yes, the fact that you can't own the underlying and the fact that it's mean reverting, and when it goes to 80, most people think they know exactly where it's going next, causes all kinds of issues. So I always just tell people, if you don't fully understand the VIX options market, just stay away from it. It's definitely a different animal. Julian asks, where do you get good quality data for all the volatility indices? This is a tough one because for me personally, I've been trading for 15 years, right? And I've been focusing on certain products and certain data points that are very important for me. And I've been tracking them every single day. So every morning I wake up, I get out my main spreadsheet, my data spreadsheet, and about an hour after the markets have opened, when everything kind of settles, because that first hour can be a little bit choppy, about an hour afterwards, I input all the current data points for that intraday moment about an hour after markets open. And at the same time, I update all of the metrics from the market close the previous day. And I've been doing this for 12 years now. I started doing this in 2009 when I launched my first website, my VIX Trader website. And so for me personally, I have just compiled the data myself. So when people ask me where do they get the good data, I don't actually know what to tell them. Obviously, Bloomberg, Reuters, things like that will definitely have it for you, but those are very expensive. The cost of a lot of these things could be really prohibitive. So where do you get data? Yahoo Finance has data. And I shouldn't say it that way. I mean, they have data, so you can trust it, more or less. If you get the historical prices, you can download a few things there. I know Vance Harwood. He's another awesome guy that you want to be following. He has a blog website called Six Figure Investing, and I know that he sells data. You might want to, there's a cost to that, right? He does a lot of work behind the scenes. He compiles the data. I could give it to you, but I don't know if there's going to be any issues with that because, of course, the data is not mine. If I give you the data from, say, the VIX 9D index, it's not really my data. I'm just compiling other people's data. So I guess Vance finds a workaround for that. I'm not sure where you get your good data from. Like I said, it doesn't apply to me very much because I compile all my own data, and I've never really needed to do those things. Sorry if that sounded like I punted on your question. Do you trade variance swaps? Dylan. No, I don't. My trading is pretty simple. I try to keep my portfolio as simple as possible. So I trade equities, mainly indexes, and volatility ETPs, options on volatility ETPs. And in my own private trading, I do trade VIX options because if you understand that crazy wild animal that the VIX options market is, you can actually make a pretty decent return. You can find strategies that work very well in VIX options, but nowhere else because of those intricate things that I explained before. But that's basically all I do. So I don't trade any futures. I don't trade any VIX futures or commodity futures or anything like that, and no swaps or anything. My portfolio is pretty basic. My analysis is maybe not so basic, but the underlying that I trade is something that anybody can trade the same things. Here's one that looks longer. Let me put it on the screen and read it. Have you looked into dynamically sizing, levering short vol positions based on the level of the VIX? Going from 12 to 24 double is much more likely than going from 25 to 50 double in a day. So as to the first part, no. The VIX index itself is a terrible indicator for any volatility trading. I feel like it's near worthless. I mean, it has a very small allocation in my volatility barometer. That's what I call my volatility index. Very, very small allocation, maybe 1.5% or something. And it's just bad. I've done a previous article, but I have it very near the top of my list to redo that article in a video because this is a really important subject. The VIX index is the most widely used, watched, quoted, and retweeted and hashtagged out there. Unfortunately, it's also one of the worst, one of the least predictive, and one of the least useful if you're trying to get a forward statistical probability of where volatility ETPs are going. It is one of the worst. So I lost it. It disappeared from my screen. So that's why I don't do that. It's just simply, I've tested it all. And again, I'll do a video showing my testing and showing you all those levels. But no, it's not useful. That other part going from 12 to 24 is much more likely than going from 25 to 50. Now you're getting into that old percentage change versus point change argument that has been going on since the dawn of time in the volatility space. I've run numbers on that. And again, I should probably find a way to present that. Should figure out a way to get more spreadsheets open that doesn't crash my computer. But I've run numbers on that, and it's just not the case. There's really no statistical variation between different volatility spikes related to the starting point, like starting at 15. How likely is it to spike starting at 25? I've not found any meaningful data that says that. If you have it, I'd love to see it, but based on my testing, I don't think that's true. I use VIX based on percentages, and I don't think that's true. I think a 50% spike can happen just as easily from 25 to 50. In fact, sometimes it feels like a real short trip to 50 if you've already spiked to 25. So, hey to you too, David Lincoln. Thanks for joining us. David Lincoln, Mr. Short Ball Show. Yeah, one of the good ones out there. Definitely give him a follow. Check out his YouTube channel. He does way more live streams than I do. So, and he talks a lot about the VIX term structure. So pretty much in every one of his live streams, he'll do some type of update on where the structure's at, what it's going to mean for volatility products. Good stuff. I tend to focus more because I have a portfolio and I have data sets related to other indexes. You could follow us both and you could see different things being presented. Andrew asks, for the new vol trend strategy, could you make more sense to do covered call in lieu of a naked short put, since VXX calls have a higher premium than puts? No, because that would be selling a naked call. And I already talked about selling a naked call versus selling a naked put. I know it seems on the surface like the naked call is the more profitable trade, but that's just a sucker's play. You're not factoring in all the things that go along with that naked call. Once you start backing out the layers of risk management that you have to add to that trade to make it even close to safe to trade, now all of a sudden you've reduced your profit to the point where just a straight up naked put will make way more money long term. So again, you're looking at the premiums of those two things and trying to make an equal comparison, and it's just not. There's a whole lot of things buried in there. Andrew says, no, I've been rambling on the wrong question. A covered call. So you want to buy the VXX and then sell covered calls on the VXX? Yep. Okay. No. Not a no to that one as well. The reason you don't want to do that, I don't ever encourage people to sell covered calls. The only time I ever sell covered calls is when I'm already in the trade and I want to get rid of the shares. And then you can sell a covered call very close to the money or even deep in the money, and you can get paid a little bit while you're on your way out the door. So if you want to get rid of a stock or rid of an index, and I have strategy called the Wheel of Fun, where we, sell the naked put. If you do get assigned, go ahead and sell the covered call and try to get rid of those shares. But the purpose is to get rid of the shares. Selling covered calls, I know it sounds like a good idea that will boost your profits, but what ends up happening is you're just cutting your profits, right? You're not really changing the risk profile of the trade. You're not reducing your risk. You're just cutting your profits. So covered calls in general, bad idea. But covered calls on VXX, the VXX doesn't go up very often. So, you're going to be ending up selling something. You're going to buy the underlying VXX and then try to make those premiums pay for it. It's a sliding scale all the way down. I don't see how that could be profitable. Again, the point of volatility trading is to get the maximum amount of money allocated at any one time, having the most amount of risk management in place. And covered calls, I'm not here to tell you no, like don't do that. I'm right, you're wrong. I don't ever do that. But I've not found any practical use to use covered calls to boost profit. I don't think that it significantly changes the risk profile of the trade. It just kind of caps your gains. So I wouldn't want to do that. And then certainly on the VXX, if anything, you'd want to go the other way. You'd short VXX and then sell, cash secured puts, but I wouldn't do that either, of course. Nope, I would just say just a general no to that question. You definitely, if you're doing your volatility trading, you want to stick to long inverse products, right? The SVXY, or Spreads on the VXX or UVXY, long put verticals, short call verticals, those are very good. Butterflies, broken wing butterflies, they're all defined risk trades. Or long put options on the VXX, further out, maybe 100 days out. Those work well. Selling naked puts on VXX works very well. Beyond that, I think the numbers fall off quite quickly. I've mentioned this before. Literally everything you do can make money. So it's never about, can I make money doing X strategy? Of course you can. Every strategy can make money. The point is to do it in the most efficient way that maximizes how much money you make and minimizes the risk along the way. So selling naked short call options on UVXY can make money. It's the least efficient way to make money, and it's going to make the lowest long-term rate of return of any of them, because when you factor in all the times you're going to lose your money and all the risk management along the way, it's going to be the worst of the worst. But that doesn't mean it can't actually technically make a profit. They all can. So remember, just look for efficiency, not absolute profit or loss. Make the most efficient profit in the safest way possible, and you'll be here for 30 years trading. Another plug for good old David Lincoln there. Going over to see your interview next. Yeah, I checked it out earlier this morning. Yeah, check out there. He's got a new interview. Does tons of interviews on there. Great channel. Yeah, actually, I was supposed to be, not to out myself too much here, but I was actually supposed to be one of the very first ones. I've known David for years, and he's asked me to do interviews on his channel. I don't even know how many times. I mean, for years. And I've turned him down because I'm terrible live. And I'm always a little bit nervous to do a live interview. So I've never actually done one. But I think he probably asked me to do an interview, I mean, certainly before Volpocalypse. So that we're talking about over 3 years ago. He's been asking me to do interviews. Maybe eventually I will do that. I don't know. I've always just found excuses and ducked out the back door. Yeah, this is exactly my point, very succinctly put. I think they become relatively equivalent. The premium on the call and the put at the same strike is mostly the same after accounting for risk-free rate and short interest. Once you make those adjustments, you have to understand that the volatility market, the options market, is quite efficient. So if you see that the calls are way higher than the puts, you're just talking about a skew there because of the probability of those calls being in the money compared to the puts being in the money. You're not actually spotting any big secret like, oh, wow, nobody knows this. We should just sell the calls and because it's way more than the puts. Trust me, every successful, sophisticated institutional trader out there already knows. They've already run the numbers. All the math checks out. There's no difference. So the nominal number, yeah, don't let that confuse you. You have to factor in so many other things. And when you do all that, you will quickly realize that selling undefined options on vol ETPs is the most inefficient way to make money trading volatility. Anybody who does it is probably new to the game. They've not run those numbers. They've not done those calculations. They've not considered what happens if there's a flash crash this year. They just haven't run the numbers. It's a little bit reckless. Fortunately, those people only exist on Twitter. You very rarely see those people who have a legitimate foothold in the volatility space anywhere but Twitter. So if the Twitter app disappeared, so would everybody talking about selling undefined risk on options. How long have we been going for? Again, I feel like it's been 10 minutes. An hour and 15 minutes. What does that mean? That I'm just completely scatterbrained and I have no concept of time? Or what's going on there? Why does it seem like I just started? Selling UVXY calls is for people running hedge funds, not their own risk. Might push back on that a little bit. I went on a little bit of a hedge fund rant before, and I criticize hedge funds as well for the rate of return. I criticize everybody who doesn't do real work to beat the market and get a good rate of return. But I don't criticize hedge funds for being stupid or being, not knowing what they're doing. They certainly do. They're certainly very, very smart people. And it's just, there's a lot of things stacked against hedge funds structurally, just industry-wise, that make it very difficult for them to beat the market. In many cases, nearly impossible. You have to be exceptional under those restrictions. I mean, they're basically handcuffed in 17 different ways, and then they're trying to actually outperform somebody like me who can just do what he wants when he wants. I mean, it's not a fair fight. So, yeah, no hedge funds are going to outperform me, or very few of them. But yeah, I won't ever be piling on board the hedge funds or, doing bad things. They're doing their best under conditions that are not ideal for investing. And that's why people shouldn't invest in hedge funds, because the performance sucks. We all know the performance sucks. But it doesn't suck because they're stupid. It sucks because of the structure and the handcuffs that are involved in that. They're just not nimble enough to do well. Yeah, I meant David Lincoln on the VIX Crush YouTube channel. He's been asking me to do interviews for over 3 years now. So, and we're friends. I'm very good at making excuses because I never wanted to go live. This whole live thing is new for me. It doesn't suit my personality at all. I'm much better if I can plan things ahead of time and edit it out and piece it all together in a video. But we'll see. I'm hoping to get good enough at this where if I do my little 20-minute presentation in the beginning, that people are getting good value from that. And then we'll just do some questions. Questions are fun. Unless you're a good one. I like questions specific to VTS, of course. Wait, I should do the first one. Winston says, if you're saying VIX indices are among the least predictable, which I kind of agree, but why are volatility barometer can be used as an indicator in strategy allocation? I said the VIX itself is one of the most useless indicators out there. Now, the VIX can be used in conjunction with other metrics, and now all of a sudden it's becoming more useful. Like if you're going to be comparing the 9-day VIX, the VIX 9D, to the 30-day VIX, the regular VIX as we know it, well, now all of a sudden you've created something that is not an absolute level indicator. Now it's more of a momentum indicator. It's a change of value, relative change indicator. And now you're onto something that might be a little bit more useful. So I didn't mean that the whole suite of cash VIX the indices like the VIX 9D, VIX 3M, VIX 6M, VIX 1Y, I didn't say that they are useless as far as building upon. I just mean there's a lot of people who say, I'm going to short volatility when the VIX is below X number. Well, you've not said anything, right? The VIX below what? Okay, a VIX of 16. What does that mean? It's just an absolute number. It doesn't mean anything. A VIX of 16 in 2021 is a completely different thing than a VIX of 16 in 2017. You've really not said anything if you're using the absolute levels of the VIX to inform any type of trading. So that's what I meant. Maybe I should have been more specific. But yeah, certainly I go into way more detail, and I try to build momentum indicators and relative change indicators and things that can really increase the probability that I'm in the right trade at the right time. And the VIX and the whole suite of indices that go with it can be useful in that. Comparing the VIX to the Volley index, for example, right? The Volley is at the money premium. The VIX measures all premium. If you're comparing these two things, you can get some pretty good idea of what's happening in the market, where those options are being traded. Is it at the money? Is it out of the money? These are all things that you can expand upon. I just simply meant the nominal level of the VIX is a somewhat useless number. John Noren says, on a lighter topic, what is your favorite golf course? Pebble Beach. Has to be, right? I've not played Cypress. I mean, Cypress is ranked, I think, #1 in the country for, forever. But it's pretty tough to beat Pebble Beach. I enjoyed Pebble. Bethpage is good. Bethpage Black. There's a lot of good ones. I've played a lot. I've been lucky. Obviously, I'm a professional golfer, so I've played a lot of good courses. But yeah, Bandon Dunes, absolute one of my favorites in Oregon. I played a tournament at Bandon Dunes when the course was first introduced. Phenomenal golf course. If you're ever in the area, go absolutely play that. Yeah, Canada has a bunch of good ones. Obviously, Banff Springs, Jasper Lodge, Jasper Park, Kananaskis. We've got some world-class golf courses in Alberta, in the Rocky Mountains. Yeah, that's a pretty good list for you, but it's tough to beat Pebble. Brian Lynn getting into some real details there. Feel like you might be ready to start a stream of your own with that level of knowledge. I'll tune in. When are you launching? I'll be in the comment section. This is interesting. Let me read this one. So if you buy a call and someone is selling you a call, both of you guys can win. Assume not hedging the underlying. Doesn't make sense. What are you trying to ask there? I think what you're getting at is the idea that it's a zero-sum game, which option trading is not a zero-sum game because your counterparty is a market maker. So, your counterparty isn't just some guy on the other side of your trade. If you sell an iron condor, there's not some person who has the same iron condor on the opposite side of you. So if you win, then he loses. Hopefully that's somewhere in the ballpark of what you're getting at there. But the options world is not a zero-sum game. So the market makers play their role, and they hedge with the underlying, or they hedge with futures and options. And so it totally changes the dynamic of the market. Why that's relevant to VIX options is because there is no underlying to hold, it does remove that direct hedge. And then, of course, there's indirect ways that you could still do it, but it causes a lot of problems in the VIX options market. But yeah, options trading, the options market's not zero-sum game. Two people, yeah, you can. Buyers and sellers of options can both make money. They can both lose money. The market maker can not do their job adequately. There's a lot of things that can happen. Hans asked, do you think any fundamental changes in markets since COVID? Fundamental changes? Not really. I think that, if anything, what I'm not even sure if I'm allowed to say that word, but I already said it, so whatever. COVID. If it did one thing, I think it prolonged this high volatility regime a little bit longer, right? Because if we go back to 2018, from 2012 to 2017, we were in a low volatility regime, historically low volatility regime. And there were spikes, the European debt crisis, the flash crash in 2010 spiked the VIX. We've seen it spike over 50 in the European debt crisis. The China hard landing scare in 2015, it went very high. I think it touched 48. But very, very quick to go down again. But Volpocalypse changed that, where we are still in a buy the dip environment, but volatility has not declined to the same low levels as it did before. And that's because there was back-to-back scares. There was the Volpocalypse in February, and then the Q4 crash, which started October 5th, and it ended on Christmas Eve in 2018. Of course, it was down over 20% then as well. So we had two events that basically meant that for a little while, we're going to have elevated volatility. And even in 2019, which was a great year for stocks, volatility didn't reach those same depressed levels that we saw before. Totally different regime. And if COVID never happened, if the markets just continued on, nobody knows for sure, but I suspect volatility can slowly start bleeding down to those normal levels. But then you introduce something like a VIX going to 82.65 or whatever it went to, 82.86. What's the number? My brain scrambled. You introduce that, and now all of a sudden we're going to be in this high vol. We're not going to see a VIX of 10. I don't know. I mean, I don't like to predict things, but it would be shocking to see volatility go down to any, lower levels that we saw before Volpocalypse. I think, if anything, that's all that the COVID did. I think the markets themselves, people have had a pretty good beat on things for a while. It's a Fed-induced market. It's a buy the dip type of market. I don't think that changed too much. Arthur Willman, any update on a ZIV replacement? Thanks for tuning in, Arthur. Appreciate the support. And I'll tell everybody in the channel, but do more videos. Your first one was awesome. No replacement for ZIV anywhere on the horizon that I've seen, which is a shame because it's my favorite product. Certainly, there's been filings for an XIV replacement, TVIX style replacement. There's certainly a lot of money in it. There's a lot of ways to succeed in this market. So I suspect more players will come in, but they might just look at that old volume on the ZIV and just realize that it never was very high. And that'll be, unfortunately, it'll hinder anybody from really taking on that market again. Now, I've said publicly on Twitter, any issuers out there, get ZIV launched. I'll make 100 videos for you. I will market as much as I can, but it's probably not going to make a dent. So they're probably going to look at the ZIV VXZ combo as just low volume. A lot of people don't understand how expensive it is to have ETFs on the market. It costs millions of dollars to have those going. And so you have to sort of clear a certain hurdle of volume before it really starts to be meaningful. And ZIV may just not do it for them. Dylan or Dylan? Sorry about that. I'm going to say Dylan. I'm Canadian. I believe they hedge with VX futures when you buy, sell, VIX call, put. Yeah, there are ways to hedge, but again, it's not going to be a direct hedge. Like if you sell an Apple call or something, they can hedge with Apple. If you do the S&P 500, they can hedge one-to-one mathematical hedging. It's a little bit easier of a job for people to do that. But when you're trying to go out into different markets, like I explained with the beta factor before, you can get a long-term average, but you can't ever tell whether it's going to be a pure one-to-one or not. There's always that over-under performance that you have to factor in. So it just makes their job harder. The market exists and they do it and the volume's great, but it's a tough market for market makers to play in. Bryce, here we go for a VIX term structure question. Looking at VIX term structure, 6.38% contango, I'll take your word for it, and 16.4% roll yield equals aggressive green light to short. Would you agree? Remove the word aggressive, and yes. I don't like when people use words like that because I don't know who you are. I don't know what your portfolio looks like. And so when you say aggressive green light to short VXX and UVXY, don't ever short VXX or UVXY. It is an unlimited loss trade. And if there's a flash crash tomorrow, you're going to know why you shouldn't short those things. So don't ever do that. Of course, in tying it into the presentation before, keep everything defined risk as much as you possibly can. But the second thing, of course, is reduce your position sizing. So when you say aggressive, do you mean like allocate a large sum? I don't change my volatility allocation size depending on the strength of the signal, because the strength of the signal today could fade away tomorrow, or it could be even stronger the next day. I don't do any rolling scale. I just allocate a percentage of my portfolio that I'm comfortable with, and that worst case scenario, if it just, blinked out and I lost it, then, it would obviously be a really devastating loss, but I would be okay. And then I just trade that level consistently. So yeah, careful there. Don't ever trade undefined anything in the volatility space if you can help it. This is a good way to put it right there. Jonathan says, feels like a bull market in fear. Absolutely. And we've had these before. This is not unprecedented at all, but I would certainly say that this is something that people are very bullish short term, but I think everybody has it in their head that this could collapse at any moment. So doesn't really directly translate to high vol, but the decisions people are making, the options that they're buying in the S&P 500, the ways that they're structuring their VIX futures trades, everybody's kind of planning for this. We know that this could just go off the rails at any time. But as long as it's still going up, everybody kind of wants to participate. So we just keep going higher. But I think you're right. Everybody's kind of, there's that fear in everybody's head that this is unsustainable. Nobody knows when it's going to stop, but it's going to stop, and it's going to stop violently. We all kind of have that same feeling. So I can absolutely relate to that comment. It's a bull market in fear. I like that. Another question from Dylan. Do you think second order Greeks are useful, such as gamma, charms, vana, and vama? No, not particularly. Gamma, you could look at gamma, charm and color maybe, but when you're starting to get into the higher order Greeks, first of all, you're going to have to calculate all of those other ones. Like if you want to know what your color is or your D Vega, you're going to have to, aggressively find somewhere that they will print that for you or just, run the numbers yourself. Totally not necessary. I always say that, while there are, over 10 Greeks, all the high order, second and third order Greeks, they're not useful. It's more of a conceptual thing. Like you probably want to know what vana is, and you probably want to know what it means with respect to, certainly with respect to the market makers and that side of the market, but just conceptually. I mean, you're never going to have to actually calculate something and say, I've got this option trade, so I better figure out what my speed is. No, not really. Gamma, I mean, just understand your delta and make sure that you're trading things that don't move violently. And then you really won't have to be too concerned with your gamma. As long as you're not letting things go too close to expiration, basically you can stick to your Vega, Theta, and Delta. And you can do everything in the options market with reasonably basic mathematical understanding. You don't have to be a math whiz to be a successful option trader. So sure, we can try to sound like we're cool, and we can say, oh, well, the Vana is really getting to levels we haven't seen, and boy, you better look out for that speed. It can get you, No, I'm not into that. And I have a math background, and I just don't find any use for those things. So, yeah, Jonathan, I think that was sort of my basic point, is that they're helpful. And some of those things, like your color and your charm and stuff, you could maybe, if you're trying to hedge a portfolio over a weekend and you want to know how strong your hedges are, you might want to, dig into it further. But mainly it is just a conceptual thing. Just understand what gamma means in relation to the market and how things move around based on those levels. Like when it is a, high gamma market, what that could potentially mean. That's what it is. It's a conceptual thing. Don't get into the math. Arthur says Vanna White. Yeah, that's a meme that sometimes we see when people on Twitter start talking about Vanna. They always have a picture of Wheel of Fortune on there. It's pretty funny. Here's one. How do you feel about selling non-cash secured puts in equity indexes? Does one need to account for the possibility of markets being closed and not being able to exit the position in a crash? Well, selling cash secured puts on its own is a fine trade, in my opinion, as long as you trade with a stop loss, as long as you're trading something that but doesn't traditionally move very much. So you don't want to be selling cash secured puts on things that can drop 50% in a day. But if you're doing it on indexes, like you said, I don't see any problem with it. You just, again, you said cash secured. As long as you're calculating for, you're actually able to hold the same value in underlying shares, then it's essentially just a long position with a little bit of a premium kicker at the beginning. You get paid to open the trade, and then essentially you're just long. It's not reducing any risk. A lot of people who think that selling cash secured puts is somehow safer than trading stocks and indexes. It's not. You're long, and more than likely your delta is fairly aggressive towards the underlying you're trading. So you just get that little kicker of the premium when you enter the trade. And so I think your question can be simply put, if you said, how do you feel about selling cash secured puts on equity indexes? If you said, I'm comfortable holding the S&P 500 at this price, that statement means that you should also be comfortable holding a cash secured put on the index in the same notional value. Why not? It's the same trade. You're just going to make, but it's not less risky. It's just, you're just getting a little bit of a buffer zone on that initial premium sale. This is interesting. I want to Google that. I don't know that name. Victor Niederhofer can provide some insight on selling naked index options. No, that's not that guy's name. I thought you were talking about that optionsellers.com, the Rogue Wave guy. That's not it, is it? Victor Niederhofer. I think that's actually a legit trader, isn't it? I don't know. You can give me some backdrop on that. I don't know who that is. How many people are in here? 70 people. And it's been an hour and a half. So I did say I would cut these off. There you go. Thank you for the backstory there. I'll look it up. He can tell me something about, you said selling naked index options? Naked meaning unsecured? I hope he's not doing that. You get into a lot of trouble. You can get overexposed pretty easily if you're doing that. You definitely want to make sure that you've matched your notional value of your short put with the actual value of the underlying that you're trading. If you're not, then why not just buy leveraged indexes? All right, let me find one more. Here's one. Assad Ishmael. VIX 9D to VIX and VIX to VIX 3M are good momentum-based indicators use and build up on. Any similar mean reversionary indicators that you like and track to build on? Well, I feel like that's kind of giving away the secret sauce. Yeah. No, I think I might have to punt on that one. I don't want to be giving away too many indicators. Because I don't know if you've noticed this about my volatility dashboard, but you will almost never see anybody talking about these things. And so it's always that question of, does that mean nobody knows about it? Or does that mean nobody's willing to share it? I don't know which one of those two it is, but I seem to be the only person who's willing to share these metrics with people. So not going to really find many of those metrics explained and calculated and detailed for people. So I don't want to go too far with that. I have to keep a few tricks up my sleeve. Come on. He blew up his fund twice. Well, there you go. That's what I said. It's great when you're selling premium and it's working and it's addicting. And a lot of people get lulled to sleep from it because you can be successful for a very long period of time before it finally comes to pay the full price on you. And that's the problem, is that you can have 20 wins in a row and it just seems like the easiest thing in the world. It's the same thing as these vol people who sell naked premium. I'm not saying that they don't go on successful runs where they get to go and brag on Twitter. I'm just saying that those same people that tweet those things, they're the same people that have already blown up their account before and will blow up their account again. It will happen. They just don't know it yet because they've been lulled to sleep by the ease at which you can just blindly sell premium, juicy premium, and most of the time have it work out for you. But that's the thing. The options market is efficient. There is no net benefit to being the buyer of volatility versus the seller. The only difference is the risk-reward profile. So if you are the net seller of volatility blindly, you're looking at a situation where most likely you will have a long string of small, easy wins and a few catastrophic blowups. And if you're on the other side, you will have a long string of losing trades that you're just bleeding your premium and your options are expiring on you. And then occasionally you're going to get one of those very big wins that might pay for the rest. But you should always assume that the net buyer and the net seller, the expectation of profit when trading blindly is 0% gain minus trade fees. So a person who blindly buys option premium, do it for 5 years, you'll make no money minus trade fees. A blind seller of premium, do that for 5 years, week in and week out, just blindly, you'll make zero profit minus trade fees. So you'll lose money. Both of those people will lose roughly the same amount of money. That's the way the options market works. If it didn't work that way, there would be an opportunity for other people to come in and just arbitrage the thing. And it doesn't work that way. So don't get lulled to sleep by the allure of selling premium. It's not all it's cracked up to be. There's a price to pay, and it's coming. It's always out there on the horizon, and it is coming. So yeah, you can start with the volatility dashboard. I've got more to introduce. Like I've got this spreadsheet, right? I've got a new correlation and beta factor dashboard that I have to introduce. I've got a lot of other metrics, but I don't just like to, I don't just like to introduce the whole thing and just say, boom, there it is. There's 50 metrics for you, because I can tell by the comments that are coming in that you guys are very sophisticated in your trading. But I also have to be mindful of the fact that I have a really large community, and a lot of those people just don't understand, and they need time to absorb it. And maybe they don't want to, maybe they do, but it takes time, right? We all have jobs and families. They're all just as smart. They need some time to absorb these things. So I try to pace it and introduce some things slowly and over time. So for someone like you with your level of understanding, it's probably moving at a snail's pace, but trust me, it's coming. I will continue building. I'll keep sharing them if people keep reading them. I'm not one of those people that, keeps all his cards hidden. I'll share some things with you, but I won't jump that final proprietary line. That's all I'm saying. All right. Maybe we should shut things down here. What do you think? It's been an hour and a half. I'm really bad at rules, and I'm very generous with my time, so I have to sometimes force myself to close the door. So let's leave it there. Thank you, everybody, for coming, for all the great comments and questions. There's a lot of legit traders, it seems, watching this stream, so that's always good. A few of you sound like you could probably start something of your own. And I'd encourage anybody to do that. There's always plenty of room for anybody out there who's legitimately trying to help investors, right? I am extremely supportive of people who do good work, and I will shout them out, and I will reference their work, and I will point you in the direction of their websites and their books. But there is also far too many people that are only in it for Twitter followers and likes and retweets and the general dopamine hit of impressing strangers online. And those are the people that I'm against. I'm strong against them, but I will always support anybody who's like a lot of you guys in the comment section who are really, really asking good questions. So thanks for all of those. Let's give it a final look here. Yeah, let's call it a day. Thanks, everyone. There will be more. There'll be many more, so tune in. Follow me on Twitter. I actually prepared a little thing here. Forgot to do this scrolling thing. Follow me on Twitter, because I will always be notifying people of any upcoming live streams through there. I don't tweet a whole lot. I basically use Twitter just to share my work, mostly as a business tool. But you should follow me there for sure. You'll always get the updates. You'll always know when the next stream is coming. And I like this style where I let people know ahead of time. But just know that if something terrible happened in the market, I might have one of those spontaneous live streams where I just say I'm going live in 5 minutes. And so you'll definitely want to follow on Twitter for that. So thanks, everyone. We will do another one very soon. It won't be more than a few days. So thanks for coming. Have a great day.